Hey everyone, welcome back to another dividend investing video. I am continuously on the hunt for some value in the market, looking for stocks of high quality companies that are growing their free cash flow and their dividend every year. And I'd like to get a bargain if I can. I want my money to go as far as possible when I'm investing it. So buying quality dividend stocks at lower prices provides both the potential for a better starting yield as well as higher price appreciation, which will grow the value of your nest egg and elevate your long-term yield on cost. Now in today's episode, I'm going to cover 3 different companies that I think are valued attractively for the long term for value-minded dividend growth investors here in the month of August 2023. Now one of these stocks I plan on buying more into this week. These stocks I see as long-term holds that could belong on your watch list, so let's get right into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. If you could, please leave a comment down below with what stocks are on your radar to buy in this coming week. I want to hear your thoughts. Let's all share our ideas as dividend investors, fellow investors here. It's great to hear about what you're all investing in. And also, if you'd like, let me know if there's a company you think is underlooked that I ought to cover on this channel. Stock number 1 is BristolMyers Squib, ticker BMY. BristolMyers Squib is a healthcare company in the biopharmaceutical industry. Its roots go back to the 1800s when it was 2 different companies, Bristol-Myers and Squibb, which merged together in 1989 to form a pharmaceutical powerhouse. In recent years, they've been a leader in the cancer and immunology therapeutics markets. Year to date, shares are down about 15%. Healthcare in general has been in the doghouse for 2023, but Bristol has some expiring patents that I think concern the markets and do play a role here in the more recent downturn. Last year, generic versions of their blockbuster drug, Revlimid, began hitting the market. Now, if we look at the last 5 years, shares are only up about 3%. It's been up and down, but with the recent price drops, could this be an opportune time to get invested in this pharmaceutical giant? I think you need to feel confident about their drug pipeline, with much of their popular and profitable products losing patent protection. But Bristol has a track record here of doing just that, and this is a challenge that any drug company has to navigate. Investors are particularly enthused about Sotyktu, which treats plaque psoriasis, and Camzyos, which treats cardiomyopathy in the EU. Now, in terms of valuation, BMY is trading at a forward PE of 7.9, which is a 16% discount to the 5-year average of 9.4, one sign of a potentially undervalued stock. Shares today can also be bought at a starting yield of 3.72%, so in terms of dividend yield theory, they are at a 20% discount to the 5-year average of 3.1%, which could be a unique buying opportunity for Bristol-Myers Squibb and dividend investors. Now, Bristol-Myers Squibb pays out on a February, May, August, and November quarterly payout schedule. They currently pay 57 cents per share for a total annual payout of $2.28. This dividend takes up a mere 29% of forward earnings and 28% of forward free cash flow. And really looking at this graph shows the outstanding job this company has done lowering its payout ratio. 7-8 years ago, this dividend was looking sketchy, but through all that, they managed to raise it, and now it's a very manageable part of their earnings and free cash flow. Simply Safe Dividends assigns them a dividend safety score of 79, seeing this as a safe dividend unlikely to be cut. And the dividend was maintained during the last recession in 2008. So it wasn't cut or raised, with 52 years without a dividend reduction. BMY has a dividend growth streak of 16 years of consecutive increases. The 5-year average annual growth rate is 7%, and the latest raise announced last September was at 5.6%. Now, while the last 10 years have not been great for the stock's performance, this is a company that has grown its earnings and free cash flow per share at a very nice clip. In my humble opinion, the market just hasn't really cared for this one recently. Perhaps it's gotten too cheap to ignore. That happens sometimes, and there are a few companies in healthcare like this. Now, the average analyst price target for Bristol-Myers Squibb is $72.92, which would represent a 19% upside from where shares are today. This looks like a company due for recovery. Just make sure you're comfortable with their ability to maneuver through these patent expirations. But again, if you're investing in pharmaceutical companies, they all have to deal with this. And there sure are a lot of fine dividend-paying companies in the pharmaceutical space. And I think you should give Bristol-Myers Squib some consideration. The next stock I think is looking good right now is Crown Castle, ticker CCI. This is a real estate investment trust, a REIT in the telecom tower space. They operate and lease more than 40,000 cell towers and about 85,000 route miles of fiber supporting small cells and fiber solutions across major U.S. markets. Now, on this channel, I talk a lot more about their main competitor, AMT, American Tower, which I own. But I thought today I'd give some love to Crown Castle because this is also an intriguing company that I believe is positioned to thrive over the coming years. It's also a really decent alternative to like the Verizons and the AT&Ts out there. While AMT is more international, CCI is US domestic. It's based primarily in the States, so your choice on which way to go could be based on that. And I think it's also not out of the question that owning both could be a decent option too. So let's take a closer look at the stock. It's been rough year to date, down 25%. Shares are even down on a 5-year basis, and today sitting right around the 52-week low. Zooming out more, this was doing great up until about 5 years ago. Shares are up about 950% since the IPO in 1998. Now, in terms of the price to AFFO, shares are at a massive discount to the 5-year average, available at a P to AFFO of 14.6. Now, the drop in share price has also brought the yield of the stock to 6%. Now, that is 78% above the 5-year average. Almost a little uncomfortable when you see things like that. You almost feel like you might be chasing yield. But this sort of thing can be a red flag, right? But let's look at the dividend coverage and see if the fundamentals are there with this company. Now, Crown Castle pays out the non-qualified dividend in the months of March, June, September, and December, in the amount of $1.57 per share for a total annual payout of $6.26. Now, when I say non-qualified, remember the REITs, these have different tax implications, okay? Often I like to prioritize these for tax-advantaged accounts. Now, the next ex-dividend date is September 14th, so you got about a month to have your shares for the next dividend payout of September 29th. As a percentage of adjusted funds from operations, CCI's dividend is at 88% of forward AFFO, so it's edging a little high. They're normally pretty consistent though in that 76 to 80 range. So a little pressure right now, but under the 90% threshold preference, which is what we want to see. Simply Safe Dividends gives Crown Castle a dividend safety score of 61, so it's considered safe and unlikely for a dividend cut. And the score is not as strong as American Tower's 79. And you know, I think a proper video, given a closer comparison of these two companies and stocks, could be helpful in the near future. So maybe that'll come in a coming video. The dividend growth track record is a little bit lacking here, only because they've been classified as a REIT for the last 8 or 9 years, and that's when they started paying a dividend. But so far they've increased this dividend every year and at a healthy clip, so the 5-year average annual growth rate is 9%, while the latest raise announced last October was at 6.5%. We should be hearing about that next dividend raise in a couple months. That dividend growth can only be fueled by a consistent growth in adjusted funds from operations. There's no other way around it. CCI has been doing a beautiful job increasing AFFO per share, especially when taking into account that these REITs often issue shares as ways to raise capital for further investment. But as long as this graph is on the rise, we are in good shape for dividend growth. The average analyst price target is $130.29, so we see a potential 25% upside from where we are today over the next 12 months. I'm okay with the lower prices on these guys right now for a bit while I'm in accumulation, even though I'm focused on AMT. Pretty much the same sort of investment, like I said. I think some money could be made here too. It's worth some further due diligence. And I expect more on these companies to come in future videos. The last stock on my list for this episode is Comcast, ticker CMCSA. Comcast is part of the communication services sector in the cable and satellite industry, but they're also a media and technology company with theme parks and studio segments. They own NBC Universal. They even own the Philadelphia Flyers. I think of this as a solid alternative to Disney. Similar company really, but without all the recent misfires and drama that surrounds the latter. Now, Comcast didn't cut its dividend either, so this is one for dividend-minded investors. And I think it's underrated, to be honest. Now, year-to-date, shares are up 29%, but bear with me here, okay? I think shares are still attractive. This was simply a case of a stock falling way too hard to the point where it just got ridiculous cheap. Now, shares still have a ways to go to recover back to their August 2021 highs. And even though they've recovered some from their drop, shares are still attractively valued and are at a 15% discount to their 5-year average forward PE of 11.7. Likewise, turning to dividend yield theory, shares are available at a 2.5% yield, while the 5-year average is at 2.1%. So this is a chance of locking in a yield that is 20% above Comcast's 5-year average. Comcast pays the dividend quarterly, paying in the months of January, April, July, and October at 29 cents per share for a total annual payout of $1.16 per share. If you have your shares by October 3rd, you'll get the next dividend payout on October 25th. The dividend makes up only 29% of forward earnings and 36% of forward free cash flow, so that's plenty of room to grow their dividend, buy back shares, and continue to grow their business. There's lots of flexibility with Comcast. Simply Safe Dividends give Comcast a safety score of 89, rating the dividend very safe, making a dividend cut highly unlikely. Comcast has a 14-year track record of growing and paying a dividend. It was increased during the last recession. It's been growing at a double-digit rate annually over the last 5 years, 11% on average, and the latest raise back in January was at 7.4%. This is a company that has doubled its revenue over the last decade, going from $64.7 billion in sales in 2013 to $121 billion over the last 12 months. Comcast is doing the share buybacks as well. Another great way to return some value to shareholders. The fewer shares outstanding, the more your shares own in the piece of the business. We had 5.33 billion shares outstanding in 2013, and today 4.27 billion at the time of publishing. The average analyst price target is $49.77, so there's potentially another 8% upside over the next year. You combine that with the 2.5% dividend, Comcast looks good for about 10% total return over the next year, potentially. One thing I want to stress here, okay? This is a stock that, while it's at its 52-week high, keep in mind the 52-week high of this year could very well be the 52-week low of next year. Everything about this stock still says buy to me. I'm not saying you should buy it just because I'm buying it, and I am going to buy more Comcast this week, but I think it's a good research candidate, certainly a nice alternative to a lot of the dead money stocks in that communication sector, so just some things to consider. And another fun fact, like the 3 stocks I've mentioned today, BristolMyers Squib, Crown Castle, and Comcast, if you were to have all 3 of these stocks in your portfolio, you would be guaranteeing yourself dividends every single month by their payout schedule. So that's also a nice bonus. And hey, if you want to know some more stocks that I am buying here in the month of August, just click into this next video. I've been purchasing all 4 of these stocks this month, putting my money where my mouth is, right? And again, these are not buy recommendations. I'm just sharing my thoughts and my own journey in dividend investing. I love hearing about what you guys are doing, so let me know down in the comments. Thank you so much for sticking around, and until next time, keep investing.